In today's video, we will explain all you need to know about investment funds and the advantages and disadvantages they bring to you as an investor. This is Investment Funds Explained by The Simple Economy. Investment funds are also known as mutual funds, collective funds, or just simply funds. What an investment fund is essentially a portfolio of investments selected and managed by an investment manager and their team. You can then buy a share in that portfolio in order to hopefully benefit from the good performance his or her portfolio delivers. The fund could hold several different types of investments, for example stocks, bonds, or property. For the sake of this video, we will explain funds through the example of the most popular kind, a fund that invests purely in shares of companies. So funds are a great option for a person who doesn't want to worry about having to research, buy, sell, and manage an investment portfolio. All is dealt with by the investment manager. This does of course come at a price. You will have to pay a management fee, which will affect your potential profit. Funds are also a quick and easy way to diversify the exposure of your money across several companies. If you buy just one stock, that is very high risk given all of your eggs are in one basket. If that one company runs into trouble, you could potentially lose all of your money. By buying a fund, your money is exposed to several companies, meaning the risk is spread across those stocks. So if you buy a fund which holds 10 stocks, for example, the exposure of your money is split between those 10 based on their weighting in the fund. So if one of those companies goes bust, the fund would of course suffer, but it would only represent a small percentage of the fund versus 100% exposure if you own solely that company. There are thousands of funds to choose from, all with differing objectives, country exposure and risk. For example, some are purely UK funds, some global, some aim to deliver a high dividend yield, some aim to grow quickly. The list goes on and on. It's important that you check what the fund's objective is and ensure it correlates to your objective for your money. You must also check the risk of the fund to ensure you're not taking risk you cannot or do not want to take. Okay, so now we know what funds are, let's explain how the whole process works with an example. Let's say I start my own fund, the Simple Economy Fund. I decide the fund will be a global fund which has an objective of growth. I, as the investment manager, would then create my portfolio, picking companies from around the world which I believe will grow their share price. You, as an investor, can then buy a share in my fund. The performance of my portfolio of companies will dictate the performance of the fund and the performance of your shares. If the companies pay dividends, the fund will pay those dividends to you as a shareholder. And if the value of the companies rise on a collective basis, the value of the fund will rise along with the value of your shares. But let's not forget about my fee. Let's say I apply a 1% management fee on my portfolio. That fee would bring the return you receive down from 5% to 4% in this example. So to conclude, the main advantages of funds are 1. They are an easy way to diversify your exposure to several investments, and 2. The management of your investments are left to a professional, meaning you are not spending time managing and worrying about your investments. And the main disadvantages are 1. You have to pay a fee which can eat into your return, and 2. There is no guarantee that the fund will perform well just because it's managed by a professional. Many fund managers struggle to outperform their benchmarks after fees. And that's it. Thank you for watching. Please do subscribe to support the channel and please leave any comments below if you have any questions.